Welcome to this week's Q&A. I want to say welcome to all of the Aussie expats around the world, but spare a thought for all the people back home in Australia that are locked down currently, and I hope everyone's coping as well as they can with that. We wish them all the best and hope that finishes as soon as possible. This week's question comes from a client of ours I was talking to here in Hong Kong, and it was over the weekend, and he said, look, what should I be doing to make sure I get all of my tax deductions for my Australian investment property? And I said, well, really, the answer to that is let's start looking at next year, the end of financial year 2022, because it's actually less than a week to this year's end of financial year. So the good news, though, is that he is actually a client of ours, so he will have actually been doing all the right things that need to be done in terms of record keeping and making sure he's had the right preparation in place. What I find these days, it's often difficult for accountants to be proactive in these things. Everyone's very busy with a lot of the administrative functions they're performing and the compliance work, etc. So it's pretty straightforward, and it revolves around certain things. So in the Income Tax Assessment Act 97 in Australia, if you have an investment property that's producing assessable income, which rental income clearly is, then you get to deduct all of the expenses that you reasonably incur in producing that assessable income. So if you've got a managing agent and they're charging you management fees, those fees are deductible. If you have repairs to keep the property in good order, they're generally deductible. If you're paying interest on a loan that was used for the purpose of acquiring that income producing property, that should be deductible. So these are all the main things that you need to keep a record of, but at the end of the day, people often forget to do things. So it's a good idea to have your managing agent provide you with a statement at the end of the financial year, which encapsulates all the income that you've received and then all of the expenses that they've paid out. Plus, if you tend to pay certain things yourself from other accounts, make sure that you also give that to your accountant, tax agent, so that they can incorporate those deductions for you. Now, that's all well and good, but then we're actually also pretty lucky being Australians, because there are a couple of divisions in the Tax Act that enable us to deduct non-cash expenses. So for example, if you've got a new property and it's just been built, you get to deduct 2.5% of the building costs over the next 40 years. That can be quite a significant amount. And then the other situation is if you have fixtures and fittings, which every dwelling has, you should get a quantity surveyor's report done, which then tabulates all of those, and the ATO relies upon that to ascertain the half-life for those various assets, and they will deduct those at a prescribed rate, which is documented in your quantity surveyor's report, and you'll be able to deduct all of those other expenses. That can have a really good impact in terms of saving you tax perhaps from another property that you might own that doesn't have those depreciation items that you can deduct because it's old, or may not have a loan against it either. So you end up with all of this positive cash flow and income, which you would be paying as an expat at least 32.5% tax on from $1. So you can potentially build your portfolio in a more efficient manner as you go along, and include some properties that give you these other non-cash deductions that you can then use to offset some of the positive income that you have from other properties. It's something that everyone needs to look at. Obviously, each position is different, but something that we've found is really attractive for people, especially if they've come from Australia. They might have lived in their house for many years, they've paid it off, they have no debt on that home, and they have no mortgage on that home. So when they go overseas, that's actually not a great position from a tax viewpoint, and we can show you how potentially you can actually do things to mitigate that and potentially use that money to increase your overall asset portfolio. So we'll go through different items, and I think it's important to recognize that these things can't happen in a week, but make sure that you have kept good records for all of your income producing assets, and if you have any queries about specific items, please don't hesitate to reach out and we're sure we can help you. I'm Andrew Unterweger from Wise Guru, and I look forward to seeing you at next week's Q&A. Once again, all the best to all of our friends back home in Australia.